Artificial intelligence isn't just chips and GPUs. Behind every chatbot, every image generator, every data center is something far less glamorous: electricity. And here is the problem: artificial intelligence uses a lot of it. We are talking demand so big that some forecasts say artificial intelligence data centers could rival the power needs of entire countries. That's a great opportunity for us investors to profit. First, we need to understand the energy and utility sector. Today, we're diving into this electricity gold rush through two companies: Constellation Energy, with a fleet of reactors no one else in America can match, and NextEra Energy, the biggest wind and solar developer in the United States. Artificial intelligence data centers aren't your typical office buildings. They're more like factories, running 24/7 and consuming massive amounts of power. To put it in perspective, some of the largest data centers can use 100 to 200 megawatts at peak. That's roughly the same electricity as a small United States city like Burlington, Vermont. However, new data centers that are being planned are going to consume up to 1 gigawatt of power at peak. Here in the United States, electricity demand was almost flat for the last decade. From 2010 to 2020, growth was about 1% per year, thanks to efficiency gains and renewable adoption. But artificial intelligence is changing that. Analysts now project that data centers could jump from using about 4% of United States electricity today to 9 to 12% by 2032. That's the fastest surge we've seen since the internet boom. It's a true gold rush for electricity. For investors, this is where the opportunity appears. Because whether it's nuclear reactors, wind farms, or solar panels, artificial intelligence can't scale without them. Let's explore the nuclear energy picture first. Because when it comes to nuclear power in the United States, Constellation Energy stands in a league of its own. They operate 21 nuclear power plants across 15 sites, making them the largest nuclear fleet in the country. They generate more than 1/5 of all United States nuclear power. That's a huge advantage for artificial intelligence data centers, which need constant, reliable baseload power 24/7. Some of the strengths of nuclear energy are reliability. Nuclear power plants don't fluctuate like solar or wind, so they provide the consistent power artificial intelligence demands. Carbon-free. There's no emissions. Many companies have net zero initiatives. Strategic moat. Building a nuclear power plant today is difficult. Cost, regulation, and timelines are prohibitive. Constellation's existing fleet is effectively irreplaceable in the short term. Here are the risks and limitations, though. Regulatory hurdles. Nuclear is heavily regulated, and new plants face long permitting timelines. Vogtle in Georgia is a perfect example. Delays and cost overruns stretched over years. Uranium supply. The United States imports about 95% of its uranium, and enrichment capacity is limited. That creates potential supply chain vulnerabilities. Scalability. Unlike solar panels or wind turbines, you can't just add another reactor overnight. Constellation Energy's growth is largely tied to its existing fleet and power purchase agreements. In short, Constellation Energy is a stable, nuclear-focused utility that already has what the market wants: consistent, clean, high-capacity power. That makes it a potential beneficiary of artificial intelligence's electricity gold rush, even if the stock isn't going to triple overnight. Please hype and like this if you're getting value out of this. It really helps me continue to deliver you amazing research. Now, on to NextEra Energy. NextEra Energy is the largest renewable energy developer in the United States. As of June 2024, their clean energy portfolio includes approximately 31 gigawatts of wind, solar, and battery storage capacity. They aim to expand this to 81 gigawatts by 2027, more than doubling their current capacity. Here are their strengths: scale and growth pipeline. NextEra is actively developing 13.9 gigawatts of new solar capacity between 2024 and 2027. Flexibility. Their portfolio includes integrated wind, solar, and battery storage systems. It's not all strengths though. Here are some of their risks and limitations. Transmission and grid constraints. Despite their extensive generation capacity, delivering renewable energy to artificial intelligence data centers is challenged by transmission bottlenecks and grid infrastructure limitations. Execution risk. The development of large-scale renewable projects involves complex logistics and regulatory approvals, which can lead to delays and increased costs. NextEra has mitigated this by adopting Japan's total quality management controls. Those management controls have a focus on operational excellence. In summary, NextEra Energy offers a growth-oriented, flexible approach to meeting artificial intelligence's increasing electricity demands. Their substantial investments in renewable energy and storage position them as a key player in the evolving energy landscape. Constellation Energy and NextEra Energy highlight two very different approaches: nuclear versus renewables. But the bigger picture is that artificial intelligence is reshaping the entire utility sector. For decades, electricity demand in the United States was flat. Now, data centers are pushing utilities into their fastest growth cycle since the internet boom. There are also sector-wide constraints: limited transmission capacity, shortages of skilled labor, and long permitting timelines. These create risks, but they also create moats for companies that already have assets in place or the ability to expand quickly. For investors, the takeaway is clear. Some utilities may finally be positioned as growth stories again. The key is figuring out which companies can convert rising demand into stronger earnings without being weighed down by costs or regulation. There are going to be opportunities for dividend and growth investors. Since you stuck around this long, consider joining me on Discord. I would love to chat with you about stocks, and since this is a small channel, you will have direct access to me. Link in the description. With that in mind, let's look at how Constellation and NextEra stack up financially. Constellation Energy is a tricky company to analyze. The company spun off from Exelon in 2022, which makes its financial history harder to track cleanly. This complicates long-term modeling since most data platforms stitch together pre- and post-spin numbers in inconsistent ways. Constellation's management publishes both base and enhanced earnings forecasts. Base reflects normal demand. Enhanced reflects higher electricity demand from data centers and artificial intelligence. Interestingly, since 2024, Constellation Energy has revised base earnings growth higher, and actual growth has tracked closer to the enhanced path. That's a bullish sign. But there's a valuation problem. Constellation trades at a forward price to earnings ratio of 33, much higher than NextEra Energy. If we plug in management's 13% growth outlook, and I know this isn't for the enhanced path, but it's the only number we have to go off of, and then we assume that the forward price to earnings multiple contracts to a more reasonable 25, we can project a 5-year return of about 40%. This is significantly less than the S&P's projected return of 76% over the same period. In short, to even match the market's return profile, the stock's price would need to fall about 20% from where it is today. To match the S&P under our 25 times earnings assumption, Constellation Energy would need to have closer to 18 to 19% annual EPS growth. This is very difficult for a utility to sustain. Because of that, I'm cautious. I'll keep watching Constellation Energy, especially if earnings keep surprising to the upside or if the price to earnings multiple contracts. But for now, I see more risk than reward at this price. Now let's look at NextEra Energy. Other than the pandemic dip, NextEra Energy has delivered consistent growth. Smooth revenue growth has been closer to 4%, while net income growth has averaged around 9%. Revenues growing faster than net income means the gross margins are expanding. We confirm this when we look at the gross profit margin graph. Rising gross profit margins supports the idea that NextEra Energy is an operationally efficient utility. On valuation, NextEra's forward price to earnings ratio is below its 10-year average, meaning the stock is cheaper today compared to its own history. Add in a 3% dividend yield and investors are being paid while they wait. One caution is share dilution. NextEra increases its share count by about 1.5% a year. That means even though net income is growing at 9%, earnings per share grows slower at about 7 to 8% because profits are spread across more shares. Put simply, dilution is like slicing the pie into more pieces. Even if the pie gets bigger, your slice doesn't grow as fast because the pie has more slices. For our base case earnings, let's start with a 5% earnings yield. This is the inverse of the forward price to earnings. 1 divided by 20 is 5%. Then we add in the net income growth of 9%, but we also have to subtract the share dilution of 1.5%. Add all this together and it's about 12.5% growth. If the multiple stays stable, that's slightly above the S&P's long-term 12% expectation. That's basically fair value. If artificial intelligence-driven demand pushes growth 2% higher and the forward price to earnings reverts to its historical average of 24, the 5-year total return could reach 136% compared to about 76% for the S&P. That implies 34% upside from today's price before the future return of NextEra would match the S&P. In short, NextEra Energy looks fairly valued in our base case with a bullish case that offers meaningful upside if artificial intelligence demand accelerates. The takeaway? Constellation Energy is a nuclear play with unique assets, but priced to perfection. Without extraordinary growth, the valuation looks stretched. NextEra Energy is a steady, efficient renewables leader with fair value today and potential upside if artificial intelligence demand boosts growth. Artificial intelligence isn't just a story about chips and software. It's also a story about electricity. That makes utilities an overlooked part of the boom. NextEra Energy shows how renewables and operational efficiency can drive steady growth, while Constellation Energy highlights the irreplaceable role of nuclear energy in powering data centers 24/7. Both companies give us a window into how the sector is evolving, but they also remind us of the risks of valuation, regulation, and execution. The bigger lesson is this: utilities, once thought of as a boring and defensive play, may now be entering into a growth phase directly tied to one of the most powerful tech trends of our lifetime. That doesn't mean you should rush to buy every utility stock. It means this is a space worth watching, learning, and researching deeper. So, what do you think? Are nuclear-focused players like Constellation the way to play the artificial intelligence electricity surge? Or are renewables like NextEra the smarter long-term bet? Drop your thoughts in the comments. I'd love to hear where you agree or you think that I missed something. We are just getting started with exploring the hidden winners of the artificial intelligence revolution. If you found this helpful, make sure to leave a like and leave a comment. It really helps a small creator, and I'd love to talk to you. Thanks. Bye.